we're going to argue today is that the recent turbulence in the financial markets have triggered what economists called a regime change, which means is the world that we were used to post recovery from the financial crisis, a very slow growth, very, very low inflation, and very, very low interest rates is over. That world is over, and we're moving into a different world where we're going to have faster growth, at least initially, a higher inflation, and higher interest rates than what we're used to. So we have to think that, don't think the immediate past is going to be a good guide for future, while the past 5 or 6 years is the immediate past was a very good guide for the future. 2% growth, 1.5% inflation, 2.25% treasuries. That's going to change. Next thing that's going on is we have this extraordinarily fiscal gamble that the administration is doing. And this is the cover of The Economist of a couple of weeks ago, running hot, and they call it America's extraordinary gamble, because what we're doing is we're doing a $1.5 trillion tax cut over 10 years, a $300 billion increase in spending, defense and non-defense, on an economy that is already fully employed. So this is a significant gamble, and the economy is going to run hot. And sometimes when you run hot, you go faster and everything's great in an automobile, but sometimes when you run really hot, you break a couple of gaskets, blow, and the car goes off the road and sputters. We think that's a real risk. So that's the other fundamental change, is we're going from a moderate fiscal policy to an all-out fiscal policy. And this has happened really in the past few months. And then on top of that is we have the current situation where we're going to be in the trade wars. And we have tariffs on steel and aluminum. And the question is whether or not NAFTA will also be on the block, because our biggest trading partner with respect to steel and aluminum is Canada, and Mexico is number 2 or number 3 in steel. So we have a real risk. And today, there's a headline on, let me just get it out here, on CNBC, from Commerce Secretary Wilbur Ross: "We're not trying to blow up the world." That's a very low. Okay, so it's a very low bar. Now, for all of you Star Wars aficionados, is the intergalactic war was started with a trade dispute with the Trading Federation. So if you really want to look into that, so the big intergalactic war through 8 or 9 movies was caused by a major trade dispute in the galaxy. So that's one of the risks that we face here right now. Okay, here's the stock market plotted to about a week and a half ago. Everything was sort of orderly. We had this big run up in January, and all of a sudden, everything looks different. So you go the whole year before January, the end of January, everything's orderly, market going up. All of a sudden, we get a lot of volatility. We didn't have that before. And if you go back further, we didn't see this kind of volatility. Next thing, the turbulence is in the bond market. Interest rates have been really quietly going up. The 10-year Treasury was as low as 2% last September. It's 2.90, 2.88, 2.87, something like that today. In our sense, that's going to go higher. So the financial markets have already beginning to recognize that there's a change afoot. And one of the big changes afoot, it will come from higher deficits, higher inflation, higher growth initially, and then we think the economy is going to slow in 19 and 20. And the thing is, what the bond market is worried about isn't only inflation, and Ed's going to talk about this a little bit, is deficits. And we're going from roughly a $600 billion deficit last fiscal year. It's going to be $800 billion this year, $1 trillion in next year, and $1.1 trillion in fiscal 2020, and it'll be over $1 trillion for as far as the eye could see, because there's a fundamental imbalance, because there were no real cuts associated with the tax cuts and the spending increases. Entitlements, as Ed's going to talk about, are going to continue to chug along and increase every year. So Treasury issuance is going to double. So that's going to put pressure on the Treasury market. At the same time, the Federal Reserve is normalizing its balance sheet, And the Federal Reserve is going to be shrinking its balance sheet by a couple of $100 billion a year. So that's going to be effectively additional net issuance, and that's going to put upward pressure on interest rates. So it isn't only just inflation, it's sort of going to be supply and demand in the Treasury market. And one of the things is our trading partners want to do, I mean, they're talking about putting tariffs on Harley-Davidson to deal with Paul Ryan's district, and they're talking about putting tariffs on bourbon to deal with Mitch McConnell in Kentucky. The simple way to deal with that is just to not buy our Treasury bonds or sell our Treasury bonds, and that'll force interest rates up here domestically. And that's also a risk that people aren't thinking. So it isn't only necessarily retaliation through the trading system, it could be retaliation through the financial markets. So the other thing we've been talking about for a while, and we've been saying for a long time, there's a major swing going on in defense spending. This was ratified with the new budget bill. And Jerry will talk about that. That's positive for Southern California. So after many, many years of declining real defense spending is on the rise, and that's going to continue for the next several years. There's lots of long lead items and what have you, and we think these numbers are probably on the low side, not on the high side that we're showing here. Here's our GDP forecast. We have roughly 3% this year. Call it 2.5% next year, but by 2020 it could be running around in the 1% or something like that. So we're going to have some problems with the car overheating, basically. Employment is growing. We have it slowing down by the end of the forecast period. ADP reported that they estimate private sector job creation for February was 235,000 people, which is way above Wall Street consensus on that. And we're going to get the official report on Friday. So employment in the near term looks very good. Unemployment rate will probably drop to 3.5%. And that's consensus right now. This isn't way off the field. It's basically a consensus forecast. In December, we were above consensus in terms of we had a stronger economy. We had lower unemployment than most people who do the survey who do this. And right now, our forecast is just a tiny bit above consensus. So this is what you're seeing here is basically a consensus forecast. And most folks have unemployment rate dropping well into the threes this year, and then probably will continue into 2019. Could be below 4 on Friday. Consensus is unemployment rate going from 4.1 to 4.0, but just as well could be 3.9 on Friday. The growth in the economy is not going to come from the consumer. It's going to come from equipment spending, partly due to 100% expensing of depreciable equipment. It is going to come from intellectual property spending. And intellectual property is defined as research and development, software, and Hollywood, motion pictures and stuff like that. That counts as an investment. They count that as an investment, like making a movie is basically an investment, or a TV show, that's an investment. And some of these things cost $100 million, $200 million. That counts as an investment. That's intellectual property. And the other area of growth is going to be business structures. And business structures isn't only office buildings and shopping centers. It's also factories, plants, utility plants, solar arrays that you see in the desert all over the place, wind power that you see in the desert all over the place, and also oil and gas drilling, which is now doing very well because of the recovery in oil prices. The big drop in 2015 there is the collapse in oil drilling when oil prices dropped from $100 a barrel to $26 a barrel. Housing's not going to do that great. Housing's going to improve. We're going to go up to close to 1.4 million. We think underlying demand is 1.5 million, 1.6 million, and we've been underbuilding for a long time. But housing, if we didn't get a boom with 3.5% to 4% mortgage rates, it's hard for us to see getting a real super acceleration with, say, 5% mortgage rates, which we think are coming. And that's why housing peaks out below 1.4 million and gradually rolls over. The trade deficit, we had the trade deficit announced for December. The trade deficit announced that came out for, I think, January today. That was a near 8 or 9 year high. And the trade deficit is going from 600 billion up to 800 billion over the next 2 years. And it's actually worse than this looks, because there's been a dramatic improvement in the trade deficit with respect to oil and gas. We still have a deficit with oil and gas, but that's been coming down huge. So the trade deficit is much worse in terms of manufactured goods than this chart would imply. And the fact is, and Ed will talk about this, is if you run big fiscal deficits, of necessity you got to run big trade deficits, and that's what we're going to be doing. So essentially, the president wants to reduce the trade deficit, but the whole fiscal policy is designed to increase the trade deficit, and Ed will go into great detail on that. Next thing is we think the tight labor market is going to bring with it higher wages. One of the things that spooked the financial markets in the beginning of February was the markets were shocked that there was a 0.3% increase in wages and a 2.9% increase year over year in January. Our guess, we may see a similar shock on Friday, another 0.3, and this is total comp wages may be 3% year over year when they report that on Friday. And so we think wage comp is on the rise. And that's going to bring with it higher inflation. And we're going to be well over 2% by May and June. And the thing is there's a lot of arithmetic to this. Sometimes economics requires sophisticated models, but forecasting the CPI near term is going to be really easy. A year ago, in April and May last year, the cellular data providers dramatically cut the prices of cellular telephone services for data. It basically reduced the core CPI by a couple of tenths of a percent in April and May of last year. That's going to anniversary in April and May this year. So year over year, the CPI, which has been running like 1.8, 1.9, is going to pop to 2.25, 2.3. And everybody says there's big inflation. And it's just anniversary those one-time cuts in cellular telephone services. And that goes into the core CPI. So we're going to be over the Fed's target. It's not necessarily in their PCE, the consumption deflator, but certainly in terms of consumer prices, we're going to see a big step up in year-over-year inflation. And this is not really so much of a forecast, it's arithmetic, because we're just going to anniversary some cuts that were made a year ago. So there's going to be a lot of scare headlines come April and May on inflation. And with that, we're going to see higher interest rates. And if you just look at it, it's the economy growing at 3%, unemployment going to 3.5%, inflation 2.5%, let's call it. What's the right federal funds rate? It's probably not 1.25%, 1.25 to 1.5%, where it is now. So we have 4 rate hikes. Wall Street consensus is 3 rate hikes. We think we'll get 4 this year of 25 basis points, and we think that will continue into next year because the inflation is going to continue. So we have higher rates. And the other thing you will notice is the 10-year Treasury goes over 4 and starts coming down, and says the possibility of an inverted curve sometime out in 2020 where long rates drop below short rates. And that's a sign that the bond market is starting to worry about recession. So if you want to tell a story about a recession, it's certainly not going to be this year. It's probably not in 2019 unless we really mess up on trade, and there'll be a whole panel on that. But by 2020, there's real risk that we could have a very significant slowdown and possibly a recession. So that's what we're sort of thinking about is as this overheated economy, basically, Fed starts raising rates, the engine begins to sputter, out of labor, we have higher inflation pressure. You could tell a story of a real slowdown, not next year, but in 2020, you could tell the story, and that's sort of what we got. Whether that goes into a recession or not, it's too early. It's too early to tell. So last time our forecast was sunny 18, cloudy 19. Well, it's still sunny 18. It's still cloudy 19. Maybe in 2020, we'll keep the weather analogy. Maybe we'll get a light drizzle or something like that in 2020. So that's sort of the forecast. And so we're in this new regime. We're going to have faster initial growth, higher inflation, with a lot of risk coming from trade because we don't know what our trading partners are how they're going to respond to the aluminum tariffs and the steel tariffs and what happens with NAFTA. It's going to be the product of a very aggressive fiscal policy on a fully employed economy as the Fed is normalizing. And if Janet Yellen was still chair of the Fed and she's seeing this fiscal policy as the good Keynesian she is, and I think she would be very scared about what's going on. A good Keynesian right now looking at this kind of fiscal policy on the economy where it is would be very, very frightened as to what the consequences would be. Trillion-dollar deficits are here to stay. We're going to have low unemployment for a while, higher long rates, and the economy will slow in 19 and especially in 20. So near term, it's still party on. Thank you.